I sat down with a business owner not too long ago. Let's call him John. Now, this was right after he'd wrapped up his best year ever. Revenue was up and he was finally starting to pay himself. And for the first time, things felt like they were working. Then tax season hit, and the bill nearly wiped out everything he had earned that year. Here's the part that catches most owners off guard. John hadn't done anything wrong. He just didn't know a growing business creates its own kind of tax problem. And if you're having a good year now, you need to hear what happened to him next. In this video, I'll show you why a great year in your business can actually create your biggest tax problem yet. Why doing everything by the books with a tax preparer still won't protect you from a high bill that you owe the IRS. And the one shift that you can make now so tax season never blindsides you again. Here's something you might not expect to hear on a video about taxes. Your brain, it doesn't actually treat money like money. Here's what I mean. There's a well-documented pattern in behavioral economics that explains it. Give a kid a $20 bill for the birthday, and they'll spend it fast. Give that same $20 to the kid for mowing the neighbor's lawn, and they'll treat it completely different. Same value, same amount of spending power, but because of where it came from, their brain sorts it into a different mental bucket, and each mental bucket comes with its own set of rules. And don't be fooled, adults do this too. A tax refund gets spent looser than a paycheck. Casino winnings, they get gambled again faster than money that you earned at work. It's not that people are careless. Well, some of them are. But it's that the brain doesn't treat every dollar the same. Here's why that matters for John, and for you as well. When revenue lands in a business bank account, it doesn't come pre-sorted. There's no little label on part of it that says this portion isn't actually yours. The government's going to want it in April. It all just looks like money. And that's the exact blind spot that got John in trouble. John's business had a generally good year. He wasn't hiding income or fudging numbers. If anything, he was doing what every business owner is supposed to do, growing their business. But here's the blind spot that catches almost every business owner in their first truly profitable year. That revenue doesn't just sit in the account waiting for tax season. It goes to payroll, it goes to a new piece of equipment, or inventory to keep up with demand. Some of it goes to John, finally paying himself what he felt he earned after years of scraping by. And by the time tax season rolls around, the income already happened. But the cash to cover what's owed on that income, spent building the business that created the income in the first place. This is where the mental accounting problem from what I mentioned just a minute ago becomes very real, very fast. Nobody labeled that slice of revenue as this is for the IRS. It all looked like business cash. It all got spent like business cash, and most owners think only about the taxes once a year in the spring, which means by the time they're doing the math, every decision that created the problem already happened. There's nothing left to plan, just a bill to the IRS. And here's the thing, John hadn't done anything wrong. He wasn't reckless. He just didn't know there was a number waiting for him that was bigger than he ever imagined. Now, John had assumed he knew what was coming. Take the profit, subtract the income tax, write the check. That's how it worked in his head. The same way it worked for anyone who's only ever had a W-2 job. But when you own the business, there's a second bill hiding behind the first one. It's called self-employment tax. And it exists because one simple fact. As a business owner, you're not just the employee anymore. You're the employer as well. Which means you're covering both halves of Social Security and Medicare. The part your employer used to quietly pay on your behalf, and the part that used to come out of your paycheck. Combined, that's a 15.3% of your business profit, and it stacks on top of your regular income tax. It doesn't replace it. Here's a little example of what that actually looked like in some real dollars. Let's say on $150,000 in net profit, that would create just over $21,000 in self-employment tax alone. Not the total bill, just that piece of it. That's before a single dollar of income tax even enters the conversation. That's the number nobody warned John about. He wasn't wrong about owing income tax. He just didn't know there was a second separate bill riding along with it. One that gets bigger, the better the year gets. Now, if a number like that made your stomach turn a little, you're not alone. And before we even get into why doing everything right still doesn't protect John from this, it's worth knowing exactly where you stand. I built a quick assessment called the Business Tax Efficiency Score. It takes about 90 seconds, and it'll give you a clear picture of how exposed you might be to exactly this kind of surprise, before it shows up as a number you can't do anything about. I'll drop the link to that in the comments below. For John, here's the part that came out of left field. He used a tax preparer, just like almost everyone does. He even made estimated payments during the year based on what he owed the previous year. On paper, John did everything you're supposed to do, and that's exactly why it was still a kick to the shorts. There's a rule called safe harbor, and it's badly misunderstood. If you pay 100% of what you owed last year, 110% if you made good money the year before that, the IRS won't hit you with an underpayment penalty. But here's the part nobody explains clearly. Safe harbor protects you from the penalty. It does nothing to protect you from the unexpected bill. If your income jumped, which is exactly what happens in a strong growth year, you can be completely penalty proof and still owe a number to the IRS that knocks the wind out of your sails. That's the trap. Hiring a professional and making estimated payments isn't the same as being proactive. Prep is backwards looking. It tells you what you owe after the year's already locked in. It was never designed to stop you from owing more than you can pay. Someone that's just doing tax preparation is looking backwards. They're telling you what you owe after the year's already locked in. It was never designed to stop you from owing more than you can pay. Now, if you're sitting here thinking, wait, that's basically what happened to me last year, you're not imagining it. This is one of the most common patterns I see in a business's first real growth year. The owner does everything by the book, makes the payments, hires a preparer, and still gets hit with a number that feels like a gut punch because nobody ever explained that by the book and protected aren't the same thing. It's not a sign you're bad with money. It's a sign that nobody ever showed you where the actual gap was. Here's the mental reframe that would have changed everything for John. Taxes, they aren't a mystery. They're just math. You have revenue, expenses, deduction, self-employment tax, all different numbers with your business. If you plug in the right numbers, you get a real, calculable answer, and that's long before April. That math isn't something you need to personally sit down and do. Your time running the business is way more valuable. But it needs to happen somewhere, on a schedule, instead of once a year by accident. And I would recommend that planning happen before December 31st. Because once the year ends, going back and adjusting your taxes gets very difficult. And the fix to the other problem, the one we opened with about mental accounting on the cash that comes in, now this isn't always just a willpower problem. It's not try harder to remember not to spend that money. It's building a system that does the sorting for you the moment revenue comes in. Business owners who get ahead of this set aside a percentage of every dollar the second it lands. Think of it somewhere between 15 and 25% of net profit, depending on how the business is structured. Now that goes into account they don't touch for anything else other than taxes. Not because they're more disciplined than John, but because they gave that slice of money a label before their brain ever got a chance to treat it like spendable cash. That's the real difference between reacting to taxes and controlling them. Reacting, that means finding out what you owe after it's too late. And all you can do is just pay it. Controlling it means you know the numbers months in advance because you built the system that tracks it and plans as you go. John's bill to the IRS wasn't a fluke, and it wasn't bad luck. It was the predictable result of a good year with no system behind it. The business owner who never gets a bill like that aren't smarter. They aren't earning less. They just stopped waiting until April to find out what they owe. Speaking of where all that money actually went, this is a problem I see constantly. A business owner looks at their P&L, sees a great profit number, and then looks at their bank account and wonders where it all went. It's the same blind spot we talked about, just showing up in a different place. If you've ever felt like your business is making good money, but somehow there's never actually any cash sitting there, I break down exactly why this happens and what to do about it, and click right here to watch that next.